Hello, welcome to the Wealthy Trades Daily Market Forecast for May 14th, 2015. Let's get started right away. Yesterday was a good day. It was kind of a boring day in the market. It was a good day for us. We did a pairs trade. We were short TEG. This trade was great. It was up about 1.35%, give or take. And then went long XLB, which was about break even. But TEG opened at 71.53 and then closed at 70.59. So really good trade there in the utility sector. And actually, utility sector is something I want to talk about. I'm going to talk about in a minute here. It is, as I've been saying, it is a safe haven play, and it's one of those sectors and stocks that people will go into as safer plays and to look for higher yields in safety, essentially, because they're higher dividend players. But as I've been saying, as these bond yields, like the 10-year yield has risen over the last month and a half to 2 months. It's risen from a 1.8 yield, right? So, which is just crazy that the 10 year is trading at 1.8%. That's nuts to me. But now it's sitting at about 2.25. So that's a big rise. That's a really big rise in a month and a half. And when that happens, these safety plays, these so-called safety plays that pay higher dividends, such as utility plays, tend to underperform because what people do is they say, well, you know what? The utility plays that are paying, 2.5, 3.5, 4% in yield are safe in a low interest rate environment. But when government rates start to rise to levels that compete with those safety plays, such as the yields in the utilities, they say, well, the utilities aren't as safe as government debt. So what they do is they start to rotate, all right, from stocks into bonds, and that's kind of what's happening right now. One thing I want to say, and I think this is very very important, is I've been saying this for I don't know, probably a year and a half, 2 years, is the yield on the 10-year note, which is sitting at 2.25% right now. The yield on the 10-year note that we need to watch for, and I think will potentially spark some major issues for our economy and the stock market, is the 10-year yield is 3%. Okay, and the reason why 3% is kind of my magic number is I think it's going to cause kind of a vicious cycle, right? Of money managers, wealth managers that manage billions and billions of dollars, rotating out of risk assets into safer assets, and it's going to give them an excuse to do that. Now, follow me on this, okay? The expected inflation over the next 10 years is between 2.5 and 3%. So right now, money managers, anybody who is managing money for institutional investors or even retail investors, they know they need to at least outperform inflation, especially for an aging population, the baby boomers. The only way these baby boomers are going to maintain their lifestyles is if their returns on their money at least outpace inflation. So if the bonds are paying, if the 10 years paying 1.8%, 2%, they can't allocate a bunch of money of their clients into bonds. They have to go into risk assets. That's a big part of the reason why we've gotten this rally in the market over the last 3.5, 4 years. Why does the Fed lower interest rates? First of all, it makes money cheaper for corporations, for individuals to borrow and then spend. But also, what it does is it forces risk assets, it forces investment assets to chase after yield. And the way that they've been doing that is putting it into the stock market rather than bonds, right? You don't want to put, as a money manager, you don't want to put your money into the bond market that's only going to pay you a 2% yield when you could put it into the stock market. In the SPY, the S&P is going to pay you about a 2% yield itself and get you growth. So they would rather do that. But that's going to come to an end when the bond market competes in yield. And I think that yield is going to be about 3%. That's going to give these money managers an excuse to take their money out of risk, or at least take a decent portion of their clients' money out of risk assets, right? Say, you know what, we've done really well, let's lock in the profits, and let's go into safety that will at least outpace inflation or projected inflation. And so I'm looking at the 10-year yield, and I really think that 3% area, I think that's going to be a key area. I think it's going to take us a while to get up and over that. But when we do get up and over that, I think we could see a kind of a mass exodus out of the stock market into the bond yields, which then causes kind of a psychological consumer confidence type of bad trickle down effect, right? What happens is they see the stock market selling off, then it's in the news and in the headlines, and consumers start to tighten up their spending. What's going on? Is the economy slowing down? That then starts to affect corporate earnings, and it's kind of this vicious cycle that kind of forces us a lot of times, and this is the way the ebbs and flows of the market, a lot of times into a recessionary environment. We then go through kind of a correction or maybe even a bear market. People kind of wake up and say, "Oh, things aren't horrible." Rates usually go down at that time. Corporate spending and hiring goes up, and then the market recovers. Problem is, and I've talked about this before too, is that until rates go up, we can't go down. So if rates don't go higher and we go into a recession, that's a bad thing. If we go into a recession with rates as low as they are right now, that is a very, very bad, unknown type of environment. We have no clue what will happen. In fact, in my opinion, that's kind of an environment that could potentially put us into a depression. Like, let's think about this. What if rates stay low, we go into a recession, and then for some reason inflation, which is kind of an oxymoronic thing, inflation spikes dramatically higher, maybe because of production going down or something like that. That would be a depressionary type of environment. I'm not saying that's going to happen, but we need these rates to go higher as the economy is doing fairly well. So the Fed has some bullets. So we have some bullets in the economy when we inevitably go back into our recession that we will go into. It's just a matter of time. So let's talk about where we're at in the market right now. Again, yesterday we did well. Short TG, long XLB. Good trade up about 0.7% overall. Really good in comparison to the market. Now I'm looking at the market right now. It looks like the S&P is probably going to open up. The SPY itself is probably going to open up right around 211, which is an area that it struggled at for a while, right? And it's trying to break out. I've been talking about this 212 area for a long time, but there's a new pivot high that I want everybody to watch out for, and I think we have the potentially today to break and close above this. Now, if we do, guess what? I think I'm on record saying if we break these major pivots on the upside and close above them, I believe we are going fairly aggressively, not like overnight, but fairly aggressively to 2,300, maybe 2,350, 235 in the SPY. So the upside that we need to pay attention to, because it does look like we're going to get a rally today, is 211.89. If we close above 211.89 in the SPY, then I think we're going aggressively higher. Now, how are we going to play this? That's good. That's good for us because remember, in our weekly trades, we're long within the consumer staple sector, and KR is our trade. And then our monthly trade, we are long the XLV and CAH is our trade. So we're going to welcome rallies, right? Even though the daily, look at this. This doesn't happen often. The daily dashboard is sitting right at 50%. That does not happen all that often. What that indicates, it means, out of these 502 stocks that we analyze, which are the stocks within the S&P 500, 50 of them, or 50% of them, are moving down, 50% of them are moving up. So you're wondering, well, why are we in a downtrend then? Because the quality of the downtrend is higher than the quality of the uptrend. So therefore, we indicate the downtrend, even though it doesn't really matter because the quality is still below 50%. So therefore, we're going to do a pairs trade. It's going to be much like yesterday. We're going to do a pairs trade, find a short within the utility sector, right? Which I like this play. I like shorting utilities right now because of rates looking like they're ticking higher. But what I'm going to do is I'm going to bring all those stocks into my portfolio, and I'm going to use my pair down technique, eliminate anything that doesn't make money. All right, so I'm going to go through this kind of quick. Eliminate anything that doesn't make money. Any doesn't make money on the trend side, so let's get rid of that. And D doesn't make money. Get rid of that. The rest do. So now these are all the 7 that make money. So now the next thing we want to do is we want to use our analysis between the trend side levels on levels, how often it closes below the trend level and how often it closes above the counter trend level. So we want this spread to be wide. So we got 38.5 and 17.3. Compare that to 40 and 9. Well, 40 and 9 is better than 38.17. So AEP is better than XLU. I think AEP is going to be the best. 34 and 17, not as good as 40 and 9, so eliminate DTE. So we're looking, so 40 and 9 is the one to beat. Nope, 36 and 25 doesn't beat it. 28 and 19 doesn't beat it. 28 and 21 doesn't beat it. And 30 and 21 doesn't beat it. AEP is the way to go. This is a really nice shorting opportunity. It hits the trend side, so it closed at 54.28. The trend side's 53.76. It hits that level very often, 55.8% of the time, and when it hits it, it typically closes below it. So that's a good shorting opportunity there if it hits 53.76. And then on the counter trend side, if it rallies up and hits 54.80, it doesn't hit that often, but when it does, it typically hits it and then closes lower. I know that because it doesn't close above it that often, and it makes money by shorting at that level. Historically, it makes money. So there's 3 entries here. Enter at the open short. If it hits 54.80, which it could because we're going to get a rally at the open, you could short there, or you could short at 53.76. But that's not our only trade because remember, the trend quality is below 50%, so therefore we need to do a pairs trade, okay? So I'm going to go into the XLB and I'm going to look for the best long opportunity within the material sector. So I'm going to move my stocks into my portfolio and I'm going to do the same pair down technique, okay? So moving those over. Let's go here. Again, looking at the levels to win profit. I'm going to get rid of anything that doesn't make money on both sides, like MWV. I did send out an earnings play yesterday on WX. They blew away earnings. It doesn't have a ton of volume on that stock, but they blew away earnings, so hopefully that play will end up well. Bought calls at for really cheap, bought the $45 calls. So we'll see how that one does. I should have a couple earnings plays today too that I'll be sending out. But anyway, again, let's find our best play here. Eliminate EM and anything that doesn't make money here. All right, so those are all good. So now we're going to look for the one with the widest spread. 30 and 23 is not as good as 28 and 11, so DD's better. 32 and 11 is better than 28, so MLM. 32 and 11. 40 and 5 is Monsanto's way better. So 40 and 5 is better than 25 and 9, is better than 30 and 11, and better than 30 and 13. So Monsanto is going to be our long. So, whoops, sorry about that. So what we're going to do is we're going to go long Monsanto. And much like our short in AEP, so we're going to go long Monsanto. It closed at 118.25. When it hits, its upside expectation is 119.77. It hits that almost 60% of the time, and it has a tendency of closing above it a lot. So that's a great. So going long at the open is great. If it hits 119.77, that's an awesome area to go long. And if we get a sell-off down to 116.73, it doesn't hit that often, but when it does, it typically bounces off and closes higher because it makes money there. So that's a great area too. So there's 3 entries on Monsanto. At the open, if it hits 119.77 or if it hits 116.73, you can go long at all those areas, close at the end of the day. Much like AEP, there's 3 shorting opportunities. Short at the open, short if it hits the downside, 53.76, or short if it hits 54.80, close at the end of the day. Those are our trades. We're going to go short AEP. Long Monsanto, close at the end of the day for the week. We're still long KR within the consumer staples sector, and for our month, we're still long in the healthcare sector, long Cardinal Healthcare CAH. Those are the plays. I will send out a few earnings alerts today. I believe we are wrapping earnings up a little bit. I will do a recap of the overall earnings plays probably next week once we get through. There's a couple plays this week that I'm looking at. So once we get through that, I'll do kind of a recap of how we've done over the last month and a half, 2 months. Had some great winners, some unfortunate losers. Overall, still up decently for our earnings plays this quarter. So anyway, let me know if you have any questions. Make sure your subscription does not expire. I'm telling you, $74 a month for all this commentary for the best, most powerful dashboard, in my opinion, in existence, to help you really stay ahead in the markets, and great earnings plays and alerts. And let me know if you have any questions. Email me, info@wealthytrades.com.